Hello, everybody. This is PC here from GlobalAlphaS. It's the 1st of June today, so I'm back with you with our usual monthly portfolio update. Let's get quickly to the details so as not to take too much of your time. I will present my screen. All right, so April shocks contained. This is the topic, the main topic I have chosen for this month as the outlier month of April turned out to end as it did, as everybody has seen, dramatic moves to the downside in most of equity indices, especially in the growth space. There's been a lot of unprecedented changes, a lot of stocks falling down 30-40% on every on just a single day, really very often. So very bad month, but start of May was actually relatively similar. There has been a lot of volatility as well, but into the mid-May we have managed to contain the volatility, and the equities kicked off a nice bounce as there has been more and more signs that at least in the short term the inflation situation seems to be peaking, especially the latest reading of the personal consumption expenditures index was very promising. But let's just get to the details, and we'll talk through all that as we go. First to kick off with is a usual portfolio overview. The synthetic internal benchmark for the month was actually flat. We were down 150 basis points, so we underperformed a little bit for a couple of reasons. As you see here in the upper right corner, highlighted in red, our underperformance versus the synthetic benchmark was 150 basis points, and versus the wide equity index, which is the S&P 500, was 90 basis points. So fairly small given the volatility, but still we underperformed a tiny little bit this month for a couple of reasons. We were not fully invested, and we lagged a little bit in the first half of May, as we still had a little bit of positioning trouble after April, and I managed to figure it all out as the month progressed. But largely, it can be said that the month was in line with equities for our portfolio. On a year-to-date basis, here in the right lower corner, you can see we still heavily outperform both our synthetic internal benchmark by 1,000 basis points, so 10% actually, and over 10% in terms of outperforming the S&P 500. This is still mostly a result of great positioning in the first quarter of this year, hedging of both equities and the long bonds portfolio at the start of the year. Right now, we do not hedge our TLT longs, as I think for the short term, the yields have made a top. So we are exposed to tilt. We still heavily underweight versus our boom respective benchmark, which is over at least 15% in TLT, but we at least do not have our position netted out to zero by hedging. Equity allocation was lowered at the start of the year. That was another reason that helped us outperform on a year-to-date basis, and directional long equities trades in the first half of May, in the second half of May, they also helped a little bit. In terms of allocation, pure equities are 42% right now. I'm obviously showing you the portfolio as of the end of month and as it stands, and with equity ETFs, our allocation is roughly slightly less than 70%. Cash is 18% right now. We also have a tiny position in Ethereum. Exposure on an aggregate basis is 85% in equities, including pure equity and equity ETFs. Treasuries are slightly less than 4%, so we underweight here, as I have already mentioned. And in terms of commodities, we're still long gold, 7% exposure, but still underweight versus the benchmark, which right now in the boom phase is also 15%. And uranium miners via uranium miners equity ETFs. I'm treating them as an actual exposure to commodities. Tiny long in the crypto, which is a long-term exposure. I do not plan to touch this for the foreseeing future. The major reshuffles we have made in May were in terms of equities. There has not been that much action. Our core equity longs are basically around the value space. Mostly we're keeping still exposure to some semiconductors like Nvidias and the AMDs of the world and this kind of stuff. But obviously our major equity holdings are now oriented towards value. So names like Coca-Cola, stuff like some of the military stocks, Lockheed Martin or Raytheon and stuff like this, right? There's been no hedges in May. I was basically trying to fish for the bottom, which we managed to do at around the mid of May, and since then we have added long directional plays in the TQQQ and SPXL. Sorry, there's a mistake here. It's SPXL. So leveraged long S&P 500 ETF, and this has added quite nice alpha as well to our portfolio over the month of May. Cash buffer has been kept at around between 15 to 25%. I think on average it was around 20% possibly. And not much action in terms of gold, hardly any change here. And in terms of bonds exposure, I have taken off the hedges, so we are no more fully neutralized in terms of our bond holdings, but we do have an exposure of slightly less than 4% in US Treasuries. Major drivers in May. The fear was reaching extremes, absolute extremes at the start and mid-May. The fear and greed factor was at 6 points at its lows. So very, very extreme readings. And obviously this brought what could have been expected. So a relief rally we are now experiencing. Inflation started to show first signs of peaking, especially as I have already mentioned, the latest PCE reading was very, very promising. But obviously there's still clouds ahead of us. The Chinese reopening is putting upside pressure on stuff like oil, gas, and other commodities. And the just introduced EU ban on Russian oil is also something that obviously does not help. And we saw oil at around $100 per barrel in terms of WTI a week or two ago. Right now it's closer to 120. So please do remember that commodities are generally between 7 to 8% of the overall CPI basket. So oil going up from here will yet be a substantial contributor to inflation pressures to the upside, right? Slower growth is now evident. Recession fears are rising. That's pretty much what everybody knows already. Growth stocks were still underperforming in May. As you saw, S&P did much better than the Nasdaq. Nasdaq was down roughly 3.5% for the month of May. The VC startup valuations are down roughly 40%. So a big burst here in terms of valuations. We saw VC deals at 30, 40, 50 times sales for more promising startups at the end of last year. Right now, these kind of valuations are something unthinkable. I mean, definitely one of the spaces where the Fed actions have taken the biggest, where the Fed actions have made the biggest destruction, I meant was the VC space and the crypto space. So that's where the Fed is trying to basically come up with their aggregate demand dampening effect. China was mostly still in shutdowns in May due to their zero COVID policy, and into the end of May, let's say, markets started to slowly price in a little bit of a more dovish Fed and some kind of a short-term inflation peak with the PCE reading finally falling on a month-to-month basis, and with the long-term yields coming down from as high as 320 to around 275 to 80% right now. There's definitely been a reason for some kind of speculation as to whether the equity markets have not, and the bond markets as well, have not priced in too much in terms of what the Fed is going to do going forward. So in terms of the policy and the kind of scenario we're following, the Fed keeps confirming that their basic scenario is the 1994 scenario, when they're managed to do a soft landing. Whether they manage to do that right now or not, time will tell. Obviously, the latest from Mr. Powell was that basically he cannot guarantee a soft landing, but he's basically trying to do everything he can. It's obviously in their utmost interest to lower aggregate demands, kind of impact the CPI pressures to the downside, but not cause a recession, which is possibly somewhere underway in the future. But the question is whether this is going to be already now in this year, or maybe sometime next year, or 2024. A little bit of a comparison as to the Fed policies in April and May. In April, as you possibly remember, there was a slew of ultra hawkish Fed talk over the whole month, a massive parallel shift in the yield curve. The Fed was talking about taming inflation at absolutely all costs, and the market started to price in 50 basis hikes, and even there was quite a bit of talk about 70 basis points hikes sometime later in the year. Getting to 2.5%, 3% Fed funds rate as soon as possible was deemed to be getting to a neutral rate, where the Fed is not supportive nor destructive in terms of the monetary policy on the financial markets. There's been no Fed put anymore. We all know that after April already, and that I don't think there's sense talking about it again. What we saw in May was basically a little bit less active Fed in terms of their talk and their speeches towards markets in general. But Mr. Powell generally did acknowledge once or twice that he or they, the FOMC, will not hesitate in terms of taming inflation, and that he feels investors currently are anticipating a series of half-point hikes are reacting appropriately in general. So I think right now they want the markets to be thinking that over the next couple of months, another 50 basis points hikes are the basic scenario. I think they will want to get to 2.5% as soon as possible, then take away this wait and see mode for a couple of months and see whether this is going to be enough for the inflation to be going lower eventually. Some FOMC participants are showing signs of pivoting towards more dovishness, and we saw that in one or two recent speeches at the end of May. But still, what's needed is a clear turnaround in inflation, and that is not the case yet. So we will need more evidence in terms of inflation peak before we see more FOMC participants going more dovish. A quick look at the inflation trends. Right now, as of May, we have 8 out of 18 major inflation gogs higher than last month. A month ago, it was 16 out of 18. So as you see here, there's definitely some progress in terms of general inflationary pressures in the US economy. But as I have said already, the Fed wants to see more signs or at least of at least a short-term peak in inflation before we see a change in rhetorics. The worldwide macro heat map, as you see here, did not really change much from last month. The pressures are still there, and you know, the issue with the debt to GDP is still there as well. So I think I will not be surprised to see the monetary policies around the world to be basically accepting higher inflation over the next couple of years for a simple reason, for the debt to GDP ratio to come down to more sustainable long-term levels. Inflation is still at extremely high levels, but seems to be peaking in some areas, as we saw already. There's a long way down the road before the government debt monetization of long-term acceptable levels to long-term acceptable levels happens. I said it already. Will slowdown turn into recession? This is the question that comes up in the media more and more often. Obviously, as you know, things unfold, the picture changes, and right now, I think on a consensus basis, recession this year is still not a base case, but there are more and more signs that it might just as well happen. Please do remember that we already have 1/4 of GDP being down, namely down 1.4% in the first quarter of this year. Impact of war on EU growth. This is a big question, especially in Europe, obviously. And I think this issue will not basically evaporate over the foreseeable future. I think the war in Ukraine will basically be a long issue we will have to live with. Zero COVID policy in China. Commodities. Quick look at the commodities. May versus April. Most of the major commodities are again either at the levels of April or higher. So in general, you know, the biggest supply side inflationary pressures issue is still there. And seems not to be abating. What is positive maybe is that on a month-on-month basis, in some areas, we are starting to see some kind of slowdown. But I think it's yet way too early to say that this is anything more than just you know, first signs of maybe some kind of a trend change. Our forecasts and expectations, we're still in the boom phase. We're now watching our coincident indicators, private payrolls and industrial productions, and are still both in the expansion phase. The delta is up 39%, but one component of it, which is the S&P, is now down year on year. So it is in the boom phase. So be watching that. The further development in coincident indicators is going to be crucial in terms of defining a potential cycle peak. We're not seeing this coming yet. That's why our basic scenario is for no recession this year, because our forecast model by Dr. Robert Daly from No Spin Forecast, is basically having a 9 months out forecasting period, and 9 months out from here is basically already in 2023, right? So a base case scenario for end of 2022 for now is no recession yet. Risks to the CPI are on the supply side. As we know, the ban on Russian oil from the European Union, and energy accounts for 7.5% of the CPI. So a very, very substantial part of the CPI index. Utmost caution is still recommended for investors until the Fed pivots. I think after April, we already know that rebounds are very probable, though as markets are now clearly ahead of the Fed in terms of pricing interest rates policy. Having seen the CPI PCE peaking, the Fed might implement a wait-and-see mode during the summer. This is my base case. I think this should happen at around August, September. But obviously the things are very, very dynamic these days, so stay tuned. Positioning wise, I plan to stay in value mostly in terms of core long equities portfolio with allocation between 40-50%, and for now at least, I think I will stay underweight gold and tilt. In terms of gold, I just see it basically going sideways most of the time for the last couple of weeks, and I don't see signs of that changing yet. And in terms of TLT, I think we're due for a bounce, but in the longer term, I think it's still too early to be loading up on the long-term treasuries, at least for now. Rebound long directional trades are to be used to add some alpha. That's what we did in May. It worked quite well, and I think we will use these opportunities to be adding some alpha to our portfolio using directional trades. The base case, we're in a boom phase, and there's more black swans ahead possible. So we want to stay cautious and protect the capital first thing, and then concentrate on looking for some very oversold growth opportunities. I think in general, value is where you want to hide, and growth will for the foreseeable future be out of vogue. One other picture I want to show you, this is the so-called zone of death. We've already talked about this. Zone of death is basically the area between plus 10% and minus 10% year-on-year change for the S&P 500. As you see here, the index is staying within this area for relatively short periods of time, but is very dynamic within this area usually. And right now we're below zero on a year-on-year basis, and this is usually at a time when we're seeing pretty big corrections in the equity markets. I think basically going out of the plus 10% from last year in terms of year-on-year basis is what we want to see before we want to call the correction or the bear market done. Thank you very much. If you consider copying me, please do remember that as long as you can is what I suggest, right? Minimum 1 year. But if you want to really enjoy the long-term added value of the strategy and be an investor, not a speculator, I do suggest that you copy me for a couple of years still. Always click copy open trades, and the minimum copy amount I suggest is $500. Please be patient and resilient through turbulences. That's the saying I want to say again, because I think this is very, very important. So thanks a lot, guys. I'll hear you in a month. Thank you.